Within analytics, today what we will discuss is, we know lot of predictive modeling is developed, predictive modeling models. In what are the areas? One is risk, one is collection, fraud, marketing. So all these areas, predictive models being developed, but none of these areas use models directly. What does that mean? The output of the model, so this is a model, the output of the model goes as an input to a strategy. This is a strategy. You will understand the significance of this window shape. This becomes a input. The output of the model becomes an input to the strategy along with some other parameters and variables, which gives a decision. And this decision is the final output which has a meaning in the business. Correct? Business doesn't want your model output or strategy output. It requires a decision to be made. So let's understand how a model is used within the underwriting strategies. So today's topic is, we'll discuss underwriting strategy. So before we understand what is a underwriting strategy, let's understand what is underwriting in the context of lending. So we are talking about lending business. We'll cover in the next classes for other areas what do you mean by underwriting. So customer A applies for a loan, let's suppose personal loan, to a bank B. Now the bank has certain options. Option A is it approves the loan, approves. Option B is decline. Approve means it approves the loan and gives the personal loan to customer A. It decline with a reason. Now in order to arrive at this decision, this is the decision, so we have to arrive. There are certain credit policy being formed. Policy is defined. And the person who oversees this is called the underwriter. And the person to whom this guy reports is called risk manager. The risk manager has the overall responsibility to manage the risk. Okay, so this is your organizational structure, but let's discuss about how do you develop the strategy. Okay, so before we go into understanding the strategy development, what we will do is, first we will understand what is a credit risk model or credit score. So credit score, I'll not discuss how to develop a credit score, that is not in the scope of this lecture. We'll directly use the credit score with the meaning what is it. So credit score generally ranges from 300 to 900 in Indian context I'm talking about. What does this mean? 900, higher the score, better is the customer. Better is the customer. Lower the score, bad is the customer. So okay, so now let's see what do you mean by better is the customer. That means when the customer A comes for the loan, when bank decides to approve, why it approves? It thinks that the customer A will repay the loan, right? And bank will make money by charging the interest rate. When bank declines customer A because of many reasons. One of the reason is customer might not pay. Now whether customer will pay or whether it will not pay, it is either if customer pays then it is 0, it is not bad. If doesn't pay then it is 1. But nobody can guarantee that customer will pay or not pay. But you can say that what is the probability that customer will pay, what is the probability the customer will not pay. That probability of customer not paying the loan is called probability of default. So essentially a credit score is a measure of probability of default. Credit score is a measure of, it is also called PD, probability of default. So that means credit score ideally ranges between 0 to 1 because probability value ranges from 0 to 1. Actually it is the case. The logistic regression used to develop the credit score actually give a value between 0 to 1. Now this 0 to 1 can directly be used, but in order of simplicity and people can understand better, because people understand score in much easier way, because score is used in many other areas like how much score you get in the exam. Similarly here, higher the probability that customer will not pay, lower will be the score. So his score is low, that means he is bad, that means the chances of him not paying the loan is high, and the score is high means the chances of the probability that the customer will not pay the loan is very low, hence the score is higher. So higher the score, it is better for the bank. So that means bank knows that if 20 customer comes, customer apply for loan, bank has set the target that it has for example 10,000 rupees to give, and each one applies for 5,000. So that means out of 20 bank can give 2 customers loan. It has to reject the 18 customer. How it will do? it will rank order the scores from higher to lower. Somebody got 880, 870, and everybody is below this. Then bank decides that it will give to these two customers the loan. So that is how bank can do. If everybody is applying at the same time, but in real life the customer applies on their own time, nobody applies together. So hence this method will not work, but the principle remains same. Higher the score you should approve, lower the score you should not approve. So now the question comes, when an individual customer comes, a single customer comes to bank. So bank doesn't have that kind of flexibility in terms of everybody is coming together. It cannot wait. Bank cannot wait. Customer will not wait for 1 year so that everybody applies. Bank rank orders everyone with respect to their score and give the loan to the good score. Bank has to decide then and there. Or so now bank develops a strategy. What is that strategy? That strategy is built on historical data. Based on historical data, a strategy is built. Using that strategy, bank can decide whether it will approve the customer or reject the customer. So we will understand in the next video how to develop a strategy. Thank you for watching the video. Have a good day.